Today we're going to tackle the problem in chapter 4, which is Dindorf Company. So we are given 4 requirements, and the first one is to set up the accounts with the balances given above. So you will notice that there are debit balances in the left side and credit balances in the right side. So this already makes it easy because with debit balances, whether it's assets, expenses, you have to put the balance in the left side. And if it's revenues and liabilities and capital accounts, you put the credit balance in the right side. Okay? This is not going to be very exciting. It's a bit boring because this is really like a real bookkeeping task. But you're not supposed to be bookkeepers, right? But at least it gives you an idea of the work of an accountant and how the numbers that you will see in financial statements when you do your final paper on analysis of financial statements, you will see the work that is involved in having those balances. Okay? So I read the case and you will see it here below. The account balances in the ledger of the Dindorf Company on January 31, the end of its fiscal year, before adjustments were as follows. So we will read it, cash and equivalents, 119,115. So as I read it, cash is this is a debit balance, so I put it in the left side, 119,115. Accounts receivable, again, asset, normally debit balance, left side. So that's 162,500. Merchandise inventory, which is an asset, debit balance of 706.80. So we put it in the left side. And then store equipment, 215,000. Supplies inventory, 15,475. Prepaid insurance is 38,250. Selling expenses. Where did I put my selling expenses? I don't have selling expenses here. I just put it here, for example. 24,900. Sales salaries, miscellaneous, 31,000. Sales discounts, this is deducted from sales. Sales is normally like, it's an expense of the company. You're offering discounts for your customers. So it's really a selling expense or more of a deduction to sales. So if sales is credit, sales discounts would be debited. But if you think of it as a cost to the business, you will realize it is a debit balance, and we put the debit balance in the left side. So that's 6,220. And then interest expense is 9,300. Social security tax expense, 9,600. And then credit balances, at least it helps you to see, no? Accumulated depreciation on store equipment is a credit balance. Store equipment is debit, but the contra asset account accumulated depreciation, 37,300. Accounts payable, 118,180. Notes payable, 143. Common stock, 300. Retained earnings, 122. 375. Sales revenues, 716,935. So the next requirement is to journalize and post adjusting entries, adding oddity accounts as necessary. So I cannot show in this slide that we have here, I cannot show anymore the book, but I will show just the entries, individual entries. And then you will see the adjusting entries here below and the way I post them here in the accounts. So let us begin with the first adjusting entry as mentioned in the book. Cost of sales, 302,990. And then minimize, well, credit or reduce merchandise inventory. $302,990. Actually, we can say here the reason for the entry is to set up the cost of inventory sold. The next one is depreciation of store equipment, 12,750. So we recognize an expense and we also increase accumulated depreciation. So how will that be possible? Second entry would be depreciation expense we can just say accumulated depreciation store equipment. And I forgot that we should have actually entered this in the T accounts. So for the cost of sales, we will create new T account. It's a debit to 302, debit of 302,990. Merchandise inventory will be minimized, 302,990. And then depreciation expense, we will create one, 12,750 debited. Accumulated depreciation on store equipment is 12,750. The explanation for this entry here is we could mention to set up depreciation on store equipment. So the next one is supplies inventory, January 31, 5,210. Purchases were debited to the supplies inventory account. So what is our entry here? Remember that here, supplies inventory, every time there is a purchase, they debit it to supplies inventory. But it seems that now what has remained is 5,210. So what we will do is this one, we will compute for what is the expense, 15,475 minus 5,210, which is the inventory. So there is an expense of 10,265, which we should adjust. Credit supplies inventory, debit to supplies expense. Okay, did you get that? So we really had to compute for the expense because what has been given to us is the inventory, meaning the final thing. So we have to deduct that from the supplies inventory in order to find out what has been the expense. So now let's go to the fourth entry. Expired insurance, 4,660. How do we record it? First of all, we have to look for the original account. Prepaid insurance is 38,250. So every time there is an insurance paid for, they put it first as an asset. But this time it mentions that what has expired is 4,660. So that will be a debit to insurance expense and a credit to prepaid insurance. So adjustment entry number 4, insurance expense, 4,660. Prepaid insurance, 4,660. So now we have to remove from the asset, which is the prepaid expense, 4,660, and come up with a new insurance expense. debit 4660. And then for the next entry, interest accrued on notes payable 3730. So we have here two interest expense. No, two accounts, interest expense and notes payable. So what has been accrued on the interest expense, not yet paid, but accrued, meaning still it has been considered expense and payable. So interest expense is 3730. So the entry would be number 5. We are recognizing interest expense of 3730 and accrued interest payable 3730. So accrued, you would think would, like when you hear it, you will see that they're accruing it, no, meaning the expense, they're really just getting all of the expenses and they will still have to pay it, or something like that, accruing. Okay, so now let's record it. Interest expense is 3730, and then there's no accrued interest payable. Let's put it here. And then the 6 adjusting entry, sales salaries earned but not paid to employees, 3575. So sales salaries earned by the workers, but they have not been paid yet. So it is already an expense to the company, still a payable of 3575. So the adjusting entry here is we will recognize an expense, sales salaries. We don't put any more expense as the account initially that we have in the beginning balance is sales salaries. And then we will recognize sales salaries payable or accrued sales salaries. 3575, 3575. Okay. So sales salaries somewhere here, 3575, and then accrued sales salaries, 3575. And then for the last entry, we have here interest earned on savings account but not recorded, 390. So to explain, this is probably something that the company would have computed, although it has not appeared in the bank as of end of the month, but still they want to recognize that they have actually earned this interest. So it is receivable from the bank, interest receivable, and interest revenue. So do we have something about interest? Doesn't seem to have one, so we can put it here. Interest receivable. Sorry, let's begin with entry. Interest receivable. $390, and then interest income, $390. And so that's in receivable of $390. And then here, let's recognize an interest income, debit of $390. So now we are in part 3, which is journalize and post closing entries. So what are closing entries? The closing entries are meant to close the temporary accounts. Well, these are not the permanent accounts. The permanent accounts are the assets, liabilities, and capital accounts. But the ones that we're closing are the revenues and expenses. And normally the really revenues and expenses are actually components of retained earnings, which is really a way to get the net income. So what we're going to do is set up the account, which is called income summary. Sometimes it's called profit and loss summary, but basically it's the clearinghouse is a clearing account for all of the closed income and expenses accounts. So we will begin and showing you the T accounts that we had earlier, but I will move to the part that is really more of revenues and expenses. As we close them here in this part, the T accounts, we will close them with these closing entries. Here below will be the specific T account for income summary. Okay, so let's begin. The first thing that we see here is sales revenue. So we will close the sales revenue with this entry. Sales revenues. Um, 716,935. And then income summary. 716,935. So it's a debit to 716,935. And with that, we actually just close this. Okay, so that's closed. And then we are also going to make an entry for 716,935, but now in the credit side. There is interest income for 390. To close that, we are going to make a debit to interest income. And then income summary. $390. And we're going to close this. And then we are going to make a credit to income summary. 390, this is interest income. Okay, so we're going to close, and then in the end, the last entry would be to close the income summary account. So we can do that now, right? I will just explain one account, or perhaps two, cost of sales and one of the expenses account. So here we have cost of sales, income summary debit 302,990. And then cost of sales, the credit 302,990. And then the next one that we have here is sales salaries. So there are two entries. One is really what we have paid for, and the next was an adjusting entry for what has been accrued but not yet what has been accrued, what is already considered as expense but not yet paid. So that is already an expense. So this one plus this one. So we will debit income summary for 109,325 and credit sales salary for 109,325. And with that, we're closing that account. Okay, so for the rest of the expenses is basically income summary debit and credit to the expense account. So I will not explain it anymore. I will not talk anymore. So you just follow. Okay, it seems that I have to mention this. It seems that interest expense, there was initially on January 31, there should have been a balance here of 9,300 and 3,730 is an adjustment. So we are going to add these two. So we will credit 13,030 to interest expense and debit income summary, and we're going to close it. Income summary, selling expense, 24,900, 24,900. Insurance expense, I think we're missing another account, which is supplies. I think when we did supplies inventory, we did not record a supplies expense of 10,265 because that is the that's the debit for this credit of supplies inventory 10,265. So we have to close the income summary to retained earnings. So how do you close that? First of all, we have to go to our income summary. So all of this has been summed up into 524,740, and this has been summed up. So the difference would be 192,585. So this is what you call the one that we will put into retained earnings. Okay, so what is it? Is it a debit or a credit? Remember that the credit balance is higher than the debit balance. So income summary to be closed must be debited to income summary, credit to retained earnings. So we are being asked for the income statement, and it will facilitate if we have the income summary, the account here. We will just plot it. I have actually just done already the income statement, the header, and the accounts. So sales revenue would be 716,935. Cost of sales would be, sorry, sales discount is 6,220. Cost of sales is 302. And then sales salaries is 109,325. Selling expense is 24,900. Interest expense is something like, we can actually put interest expense here. So we'll put this up. Okay. Total expenses will therefore be all of this. So here, depreciation expense is 12,750. So interest revenue would be 390 less interest expense of 13,030. That will make it net income of 192,585. We can just do this income before other expenses, other income, and this one is our bottom double, 192,585. Did we get that? 192,585. Okay, so somehow it's easier when you have the income summary. So it's easier to come up with the income statement. So now we are in the last part of the requirement, the part 2, which is the balance sheet. And with this, we only need to look into the T accounts, which has the permanent accounts. The cash and equivalents would have 119,115. So this is the one that we're taking, 119,115. Next, we're taking 162,500. 162,500. The inventory right now would be this one minus 397,690. 397,690. Then 215,000 for the store equipment. And then supplies inventory, we saw this in the adjusting entry. So this one minus C18, 5,210. Prepaid insurance, 33,590. Interest receivable, I think I can remember, this is 390. And then depreciation, you remember the depreciation is the total of this one plus this one, 50,050. Account 118,118. Notes payable 143,000. Accrued interest payable 3730. Accrued salaries payable 3,575. There is really no reason for me to just to put this in it's not part of any accounting process to put this in yellow. I'm just saying I have gotten this, but I discontinued it when it came to here because you might say it's necessary. No, it's not. Common stock is 300,000. Retained earnings beginning 122,375. The balance, the one that we had earlier, 192,585. So this is profitable company, earning a net income of 192,585. Okay, so I hope you learned a lot from this example, and you learned a little bit about the somehow manual task, but it still is analytical to be a bookkeeper, to be an accountant. So we can work hand in hand, accountants and doctors and many other professionals. See you in the next one.